Greetings, members, one and all of the Salivation Nation. It is my distinct honor and privilege to introduce you to Lior Gantz. I've interviewed him several times before about the state of where the markets are with precious metals, mining, and the economy in general. And a lot has happened over the last couple of months with the Fed, with where gold and silver are going. A lot of people's predictions on where gold and silver have been going or will go have been wrong. And we want to talk with Lior and see what he thinks. I think a lot of what Lior has said in the past, I think will probably come true given where the psychology of the markets have been. So Lior, welcome, sir.
Thanks for having me back.
So Lior, first question. You know, a lot of people have been talking about gold and silver in bullish terms, and rightfully so, considering where the Fed is going, where the markets are going. Some people feel we are starting a recession. Where do you see precious metals now, considering that silver has just dropped below $20 an ounce and gold did briefly hit below $1,800 an ounce?
We have been on a 13-year deflationary expansion, right? Between 2009 and 2022, let's say until 2020, you had a definite deflationary expansion. What I mean by that is central banks can lower interest rates to zero. They can create a lot of credit, and the economy can keep expanding, get to lower and lower unemployment rates, and this would not create any significant inflation, very muted inflation. In other words, the economy is able to absorb more and more debt and support that way more and more growth. And in that type of deflationary expansion, tech companies do amazingly well because they can grow through cheap debt and innovate, expand, etc. 2020, you have this once in 100-year event. Not talking about health-wise, but just talking about economy-wise. We've never had a situation where you had so many people going on live television saying that we should shut the economy down for 3 years. If you remember March and April 2020. So obviously no one has a playbook for this. Governments went on a panic. Central banks went on a panic. And we basically ended the deflationary expansion and entered some sort of a crack-up boom from all of the stimulus for about a year. But once that fizzled out, we basically exhausted this almost 13-year of a deflationary expansion and entered an inflationary recession. And that's where we are right now. We are in a recession. It's an inflationary recession. And because of that, the playbook has changed completely. So we have a valuation reset in the stock market. We definitely have a valuation reset in cryptocurrencies. We have a valuation reset in bonds because we're no longer in a deflationary expansion. So rates are rising because of what happened health-wise, has held steadier than most other things because people want their own space. They want to live in an area that's their own. So it's very important to them. Real estate has become a passion for people. They will not pay a car loan, but they will pay their mortgages. So real estate has become very steady. And in this environment, gold is down like 2-3% in 2022, something very negligible. Silver, which is more of an industrial precious metal, is down much more because it's connected much more to the recession and to dollar strength right now. So to me, once we finish the inflationary recession, we will be in an inflationary recovery. The inflation part is going to stay with us for a few more years. So the tech valuations, I think, that will stay low, and I think what will rise up to the surface are companies that are able to produce a bottom line profit right now, and companies that are commodity related. And if you look at 2022, just to wrap up this answer for you, with companies like Netflix down 75%, global brand names, Meta, Facebook that is, Google, Nvidia, all of these seemingly anti-fragile, not vulnerable, invincible companies down 40, 50, 60%. when you look at gold, it has done exactly what it should do this year. I would not expect gold to be trading at all-time highs in an inflationary recession. I would expect it to hedge my wealth, and that's exactly what it's done in 2022.
And that's why we are seeing the gold to silver ratio getting dangerously close to 100 to 1. It is now 90 to 1. And so let's talk about silver then. I think you correctly stated silver is an industrial metal as well. It has a dual purpose. So where do you see silver going from here on out?
Yeah. Silver right now is going to be in trouble. So long as Wall Street is pricing in a recession, there's no hope for silver to really rally, because you're seeing the dollar at a 21-year high right now compared to other fiat currencies on the DXY index. So very similar to like post-dot-com bubble plus 9/11, where silver went as low as $4. But then as you start to expand and get into this inflationary recovery, I think that you will see way more upside for silver. So in my book, the Fed raises rates by 75 basis points on the 26th and 27th of July, their next FOMC meeting. Then the Fed funds rate is basically at 2.25. It's above neutral. At that point, I think they raise rates in September by 50 basis points to 275, and then basically start to pivot to say, look, this is as much as we need to go on interest rates. There's no need to raise interest rates further. All the other inflationary problems are oil, food, supply chains. The government should handle these, but we have done what we needed to do in order to stabilize interest rates. We have definitely stabilized frothiness or euphoria in the markets, and that's what we needed to do. Now it's up to the government. I think when that change happens, along with the midterms, is when silver can start rallying in the back half of the year. But between now and September, it can go down to 18, 17, 16 an ounce if there's a real capitulation. So that's where my mind is at with silver. Long term, I think silver, and when I say long term, I mean 2, 3, 4 years. I think silver is going above 35 towards the 40s as we enter the inflationary recovery.
Can you talk a little bit more about what an inflationary recovery is? Because those two terms sound kind of at odds with each other.
We have a global labor shortage right now. There's more job openings than there are applicants available. Throughout the world, there is supply chain issues, there are manufacturing problems, there are port closures, and there's a war between Russia and the Ukraine that's impacting commodity prices. There's closed borders. There's a lot of ESG compliance that's making mining more expensive, oil and other commodities. All of this is very inflationary, but it doesn't mean that management teams and companies and businesses cannot innovate and still grow. So you can have a recovery that is of an inflationary nature. It just means that CPI numbers are going to be much higher than we've seen them. So the Fed wants to keep inflation at about 2%. That's called the net neutral. I believe in the next 2, 3, 4, 5 years, CPIs will range between 4 and 5. So way above that, and that's what I call an inflationary recovery, where you have the CPI way above what the Fed wants it to be, but still the economy is growing. We're building more homes. Millennials are getting married, forming families, having children. America is booming, but we have to get through the hurdles that we have right now. Right now, it's think about it this way. Think about a phenomenal racing car that has just too much power. They put too much turbo on it when they made the car. The tires cannot fit the amount of horsepower that there is in it. So it's a good problem. We need to get better tires, maybe lower the horsepower a bit, and then we're off to the races because the car is great. but the driver cannot drive it right now. It just spins too much and all that kind of stuff. It's not like there was an accident like in 2008 where the car was busted. It's a good car, a very good car, even too good of a car. And now all of the mechanics are basically fighting over how to lower some of the horsepower. That's what we are right now. So we have a very good starting point, but we have to get through these pains in order to move forward again. It's very hard, and you can see this in the consumer sentiment surveys. It's very hard to convince Americans to go back to work, to save, to enjoy life when they see food prices and gas prices so high. The Americans have not lived through inflation in many decades, because you had 500 million Chinese farmers coming in, urbanizing, and supplying everything that you'd ever want in consumer goods for very affordable prices. So this globalization period is over. We're definitely deglobalizing, and it's going to be inflationary. It's going to introduce things that we haven't seen in America, like problems with supplies of things. It will take 60 to 90 days, where it used to be like tomorrow. Those are big changes. So I think that should be something that people understand. But it doesn't mean that the economy cannot grow. GDP can grow. What is a recession? It's when GDP contracts. GDP can expand again, and we'll still have inflation. It may sound contradictory, but it's not at all. Probably towards the first quarter of 2023, we'll be in a recovery already.
That makes sense for sure. Now, one thing that troubles me is all of the money we have been spending in this country. I think 40% of the total money supply was created the last couple of years here, and that is money that printed out of thin air, and that is what led to this inflation.
Among other things, yes.
Among other things, but it was the biggest driver. And so what are we going to pay the piper on that? I mean, massive debt, almost $31 trillion in deficit spending here in this country. When will that come back to bite us?
I think it's biting us already to a degree. If your question is basically hinting towards some sort of a Weimar Republic event, I don't think that that's where America is going. America is a country that can sustain these debt levels. What happens is the Fed overshot how much credit can be added, and the government added to the economy to basically bridge the gap of all of the people that lost their jobs and whatnot with stimulus, because stimulus obviously 1,400. It's an arbitrary number. There was no big science behind it, and so you saw a lot of reports in the news of people making twice what they would usually make. And some people say, I don't even need this. I'm good. Like, I want the government to have it back. We don't need to spend tax dollars on me. I'm fine. So it was like a blanket response to the income gap that was created when all the businesses were shut down. And I think that America will simply grow into it. The economy will keep growing, and it will grow into this new level of debt. At the same time, the Fed will shrink its balance sheet, but the national debt of America will always grow if the population grows. It will just do that. Where it gets tricky is if it grows disproportionately to the growth in population, and I think we're not there. Obviously, 30 trillion sounds like an insane number, but household wealth in America is over $120 trillion. So even if you count in the unfunded liabilities, America's wealth is greater than its liabilities. The liabilities, if you calculate unfunded liabilities and everything like that, you're still nearing 100 trillion, whereas household wealth, like I said, is 120. On aggregate, I would say this should not be your main concern as an American, the threat of a Weimar Republic hyperinflation. I think for Americans, the greatest threat is obviously anything that has to do with enemies that will or will not use cyber attacks, big cyber attacks, anything that has to do with nuclear, and of course just the global shift of power towards China incrementally over this century will definitely create friction in American dominance around the world. There will be countries that will all of a sudden reject American soldiers being in the country. They will close down bases. And the more China gets political leverage over other countries, especially in Asia, the less American influence there will be around the world incrementally. So I would say those are the three major threats to Americans. In terms of like just the dollar and how you should think about the dollar in general is going to lose purchasing power. So obviously throughout your lifetime, it would be much wiser to be an owner of equities, of businesses, of real estate, of alternative assets than to save in U.S. dollar. The government is basically telling you, don't save. That's what they're basically signaling to you with their with the way that they manage the currency.
Yes, and by extension, I think that the less influence that we have militarily could have an effect on the dollar as well too. But I do agree with you. We can kick the can down the road for quite a while here with the dollar. Its strength, I mean, it's utilized. It's so injected in the whole world economy that, and with the dollar index, as you mentioned correctly, that it is at a 21-year high. Talking about globalism, everything kind of is gathering in that realm, and where we're going with potentially resetting the order of the financial and economic system. The World Economic Forum has been meeting and talking about this great reset, and that's something that is of concern, I think, with many of us that pay attention to these types of things. And I'm with you. I don't think we're going to see a Venezuela situation with the dollar anytime soon, but it does concern me for sure. If you look at the numbers, and of course the numbers can shift and change depending on the sources you have. Seems like our debt to GDP ratio is pretty high these days.
You should always be concerned. Being concerned and being obsessed about risk is the essence of a very good and reasonable person. Shutting your eyes and being rosy like my shirt or something, or on the other hand, going to the bunkers and growing your own food and whatnot. Those are the two extremes. But for most people that succeed and grow their wealth, etc., they are always on the wealth train, but ready at any point to either jump or board off. You should be ready for things, and I think that's where gold comes in, and that's where alternatives come in. That's where a good career will come in. So all these things are really important. For me personally, what I did was I calculated how much my family unit spends on a given month, and then I said, look, if there's a 2-year of a really bad recession, even close to a depression, I want to have 24 months worth of physical gold. And that's what I did. I took, let's say my family unit spends $5,000 a month times 24 months. That's $120,000. Take that, move it from savings, from fiat currency to physical gold. And I feel like 2 years is a good amount of money in today's standards for me to basically keep my living standard during a depression using precious metals. So that's step number one for me on this path. And as I progress through life, in other words, I'm going to be 38 in a couple of days here. As I progress through life, the more I get older, the less I'm going to have in the markets, and the more I'm going to have in fixed income and in real estate, because those asset classes, their volatility level is way lower. So if I need any of the investable funds that I have, a freak year like 2022, you saw what it did to stocks. Imagine you were thinking about retiring in 2 or 3 years. Man, a year like this can keep you working for another decade, because you don't know how long it would take the NASDAQ to go back to its all-time high. It could be 3-4 years before it does that. And if somebody had $1 million, he now has $800,000. That's 20% of your life's net worth gone in 6 months. That's a lot. So I think that you should always be suspicious and always be concerned, but you should play the game. It's not a reason not to be involved. It just means you need to be sophisticated. But if you are 100% gold, that could be tricky. Let's say it's 1980 and you're 100% gold. Well, for 20 years, you went from 850 an ounce to 250 an ounce. And let's say you're 100% in cash. Well, we know what happens there. So this sort of a basket and diversification is critical as an investor and as a citizen of the Western world, where capitalism is a big part of how we live.
To kind of sum up here about diversification and doing your research, and you have done that. You have wealthresearchgroup.com. I'll post a link in the description of this video if you want to reach out. Any closing thoughts here about where we're going, or just in general in terms of investing and diversification and where the markets are going?
Yeah, three things. One, I created 2 great PDF downloads for your viewers on these topics. One, on why I think the Biden administration is very weak and will not be able to pull us out of this very quick. If you go to wealthresearchgroup.com/crash, you will download a report that talks about how Biden is failing and why the lack of creativity is immense in Washington right now, and they're very inept to deal with these changing environments. And I think the graphs and charts there will be very important. Secondly, wealthresearchgroup.com/pain, PAIN, and that's about the recession and about the housing market, which I think many people are, where's the housing market going? If you go to wealthresearchgroup.com/rug, like a rug pull, RUG, I think those 3 reports are very important. Secondly, globalization. We have entered a period of deglobalization. It's a 40, 50-year cycle. We've just ended a 70-year globalization cycle that started in 1950 and ended in 2020. We're starting on a 40, 50, 60-year cycle of deglobalization. What does that mean? Well, history tells us that between 1910 and 1950, the last deglobalization period, we had the formation of the central bank, World War I, the Roaring '20s followed by the Great Depression, and World War II. 2 nuclear weapons to drop on Japan to end the deglobalization period with so much pain that we ushered on this new era of peace, basically, or a relative peace. So just head in there that we are starting a very different environment than the one that we've all been living in the last 70 years. Way more problems, and I think Putin invading the Ukraine is like the starting gun of this era, and you may even see China and Taiwan clashing and whatnot. So think about that. And obviously, like the wall with Mexico, between the United States and Mexico, that's all part of deglobalization. Okay, so you have that secondly. And I think third is what I call the deception of the markets. So the markets started to price in a recession as early as November 2021. When I looked at Google Trends for auto loans and for iPhone sales, even in November and December, during the holiday season, I saw that they were dipping. And when the year started, I said we will have a very difficult year for the stock market. It would be the worst year since 1932 and the worst year for bonds since like 1800 or something. But I think that the markets have priced in a lot. And I wouldn't be surprised that as Main Street complains that things are the hardest for them, that the markets will already start to rebound. So just make sure you don't try to time the market. Look at companies that you love. Look at companies growing. Look at companies that are cheap and attractive. And if you think that they'll keep growing for 10, 15, 20, 30 years, you should be actively starting to accumulate individual companies. I think the indices, the S&P 500, the NASDAQ, etc., I think they will be on aggregate very flat for the next 2-3 years, whereas individual companies that you find and are executing on their business model could actually outperform the indices. I think that's a big change between what we saw in the last 13 years, where you could just invest in the NASDAQ and be as smart as one of the top hedge fund managers in Wall Street, because the NASDAQ is compounding at 14% per year, something that's hedge fund material. And I think that is ending. Now it's about picking companies and not about just blindly buying the indices.
Thank you, Lior. It's been a pleasure. Always appreciate your insight and knowledge. And want to thank you all for taking the time to watch this video and encourage you to please rate, share, comment, and subscribe.